Diving into business finances, it can sometimes feel like you're trying to learn a whole new language.
Oh, absolutely. It's complex stuff.
But today, we're going to unpack two really key terms: bookkeeping and accounting.
Yeah, fundamental ones. And the sources you pull together, they really lay out the differences and why they're so crucial.
Exactly. So our mission really is to just give everyone listening a clearer handle on this, make it feel less daunting, whether you're running a business, thinking about it, or honestly just curious.
Sounds good. And it's funny how often they get, bundled together, bookkeeping and accounting.
Here you go.
But they play pretty different parts. Think of bookkeeping, maybe like keeping a detailed diary. It's that day-to-day task of noting down every single financial thing that happens.
Okay, so money in, money out.
Uh-huh. Sales, purchases, paying bills, getting paid, all of it.
Right, so if we imagine, say, a small bakery,
Right.
the bookkeeper is the one writing down sold 10 loaves, bought flour, paid the electricity bill, like the nitty-gritty details.
Precisely. Then accounting. Well, accounting takes all that data, all those diary entries the bookkeeper made,
Uh-huh.
and steps back. It interprets it. It's about understanding the bigger financial story.
Ah, okay, so using those records to see, like, is the bakery actually making a profit?
Exactly. Or what are our biggest costs? Are sales trending up or down? It's analysis, reporting, looking for patterns, making sure you're following the rules.
So back to the bakery. The accountant would prepare the profit report, maybe figure out croissants are the big seller, or flag that ingredient costs are creeping up.
That's it. So the core difference, really. Bookkeeping records what happened.
Gotcha.
Accounting helps understand what those records actually mean for the business.
Okay, that makes sense. So why are both of these things so, utterly vital?
Well, linking it back to just running things,
Hmm.
good bookkeeping and smart accounting give you the financial intelligence you need. Simple as that.
For making decisions.
Absolutely. How do you know what price to charge? Or where you can cut costs? Or how to plan for growth if you don't actually know where your money is coming from and going? It's like
Right.
like trying to drive blindfolded.
Right, you're just guessing.
Yeah.
And it's not just internal stuff, is it? The materials we looked at really hammered home the legal side. Compliance, taxes.
Oh, that's huge. Messing up taxes is, well, not good. And think about getting a loan or attracting investors.
They want to see the books.
They demand clear, organized financial statements. It builds trust. It shows you're stable. You know what you're doing. It's the proof behind your business story.
And fraud detection too, right? Having things organized helps spot funny business.
Definitely. It's like a security system for your finances.
Yeah.
Spotting errors, catching potential fraud. It all relies on good records. And planning, budgeting for the future, that comes from looking at past data.
Okay, so vital for control, compliance, funding, security, planning, pretty much everything.
Basically, yes.
So let's shift gears a bit. The principles behind accounting. The sources mention GAAP, generally accepted accounting principles. Sounds kind of official.
It is, but think of it as the shared language, the rule book for finance. It ensures everyone's kind of playing the same game, reporting things similarly.
Makes sense.
Take the going concern principle. It basically assumes a business isn't about to go bust tomorrow.
Okay, a reasonable assumption, Hope.
Right. So you prepare financials assuming it'll be around, but if there is a big risk it won't be, you have to disclose that.
Got it. What about the accrual principle? That one feels a bit less intuitive.
Yeah, it trips people up sometimes. It just means you record revenue when you earn it, not necessarily when the cash lands in your bank account. And
Yeah.
same for expenses, you record them when you incur them, not just when you pay the bill.
So the bakery sells a huge cake order in March, delivers it, but the client pays in April. The revenue counts for March.
Exactly. Earned in March. And if the March electricity bill arrives in April, that expense still belongs to March because that's when the electricity was used.
Okay, matches revenue to the expenses incurred to generate that revenue. What else?
Consistency. Pretty straightforward, stick to the same accounting methods year after year so you can actually compare performance properly.
Right, no switching how you value things just to make the numbers look better.
Precisely. Then historical cost, usually you record assets like, say, that bakery oven at the price you originally paid for it, not what it might be worth today. It's subjective.
Even if its market value changes.
Generally, yes. And materiality, this is about significance. Do you need to report every tiny detail? No. Only things big enough or material enough to potentially influence someone's decision.
So a tiny error in sugar cost might not matter for a huge chain?
Exactly, but for a tiny corner bakery, maybe it does. It depends on the context.
And conservatism. Sounds cautious.
It is. It means if you have potential losses looming, like a lawsuit you'll probably lose, you should account for that possibility now.
Okay.
But for potential gains, like expected revenue, you only record it when it's pretty much certain, like when the sale is actually made. Don't count your chickens before they hatch, basically.
Got it. Be realistic about losses, conservative about gains. So these principles, they form the basis for the actual financial statements,
They do. The statements are like the key reports card for a business's financial health.
like the balance sheet.
Yep, the balance sheet. It's a snapshot at a specific point in time. Remember the equation. Assets equals liabilities plus equity.
What you own equals what you owe plus the owner's stake.
You got it. For the bakery, cash, ovens, maybe some flour inventory, those are assets. A bank loan, money owed to suppliers' liabilities. The owner's initial investment plus any profits kept in the business, that's equity. And it must balance.
Always. Okay, then the income statement, often called P&L.
Right, profit and loss. This one covers a period of time, like a month or a year. Formula's simple. Revenue minus expenses equals net income or loss.
So, bakery's total sales for March, minus the cost of flour, sugar, wages, rent, gives you the profit for March.
Perfect. Then there's the statement of cash flows. Super important.
Why? Super important. Isn't profit enough?
Not always. A business can look profitable on paper, but run out of actual cash. This statement tracks real cash moving in and out from operations, investing, and financing activities. Tells you if you can actually pay your bills.
Ah, okay. Profit isn't the same as cash in the bank.
Definitely not. And briefly, there's also the statement of changes in equity, showing how the owner's stake changed. And finally, standards like GAAP or IFRS internationally just ensure these statements are consistent and comparable between companies.
So wrapping it up then, the big takeaway is, bookkeeping is the meticulous recording, the foundation.
Those what?
And accounting is the analysis, the interpretation, the so what that gives you the real story.
Exactly. Understanding these basics really gives you powerful insights into how any business is really doing, which actually leads to a thought. Think about the businesses you interact with every day. Your local coffee shop, maybe a big retailer online, whatever. Based on what we've talked about, what kind of financial story do you imagine their records tell? What questions about their financial health do you feel you could ask now? Something to mull over.